transferring funds from the cash that we have on hand from the proceeds of the Cedar Haven sale to the retirement fund, and this is something that's been talked about, I think, almost since the inception of the talks on the sale about using a good portion of those proceeds to bring the retirement fund up to a healthier level and a level that our bond rating agencies will see as healthy as well, and hopefully continue to increase it like they did the last time. So have that conversation go on today and potentially move these funds in there to bring the pension fund up over 80%.
It's, again, as Jamie said, it's consistent with what we had talked about over any number of months of taking a portion of the proceeds from the sale of Cedar Haven and funding the pension plan. And we had talked about $6 million that would go into your general fund reserves, and then $10 million would go into the pension plan. So that would get you over 80% funded. From a rating agency perspective, the replenishment of the reserves that you had drawn down over a period of years to subsidize Cedar Haven would be a very strong positive. I think we had talked about this before, but the three most important things to them are cash, cash, and cash, and that's about all they look at anymore. But they also do look at your pension obligations and the percentage that is underfunded. The deposit of $10 million would get you above 80%, which would be deemed to be a healthy unfunded position, if you could say it that way. There aren't a lot of pension plans that are 100% funded, so anything over 80% is considered to be reasonably funded. But we do think it would be, from a rating perspective, very positive to deposit $10 million into the pension plan. The alternative really would be to go spend that money as part of your general fund on an annual basis, which would be a very strong negative to the rating agencies. They do want to see structurally balanced budgets each year, meaning that you're not using cash reserves to fund your operating budget. But the $6 million to replenish the drawdown over a period of years also would be a very positive event. We think at that point you're probably, if not ready to receive an A rating, very, very close to it. We think that the infusion of cash into the pension plan and the reserves will get you, and a structurally balanced 2016 budget would get you back to that A category.
The idea of the balance from the assets, cash assets from the sale of Cedar Haven, you made a $4,062,000 ARC payment in December of 2014 from those proceeds, and again in just recently, May or June, $3,022,000 ARC payment, which was actually lower than we anticipated when it was recalculated. So you have remaining $18.7 million in cash from the proceeds. $10 million would obviously leave you with $8.7 million, which I believe is a pretty healthy number. That is
probably 100 days of cash on hand.
Yeah, it's 3 going on 4 months of absolute cash on hand. You still have a little bit of reserve then too that's left that you've been holding from some refunds on health insurance premiums. So, all total you're closer to $10 million in cash then. And
of course,
I think
that's a
really
good feeling going into this. We're already in this budget process with the state, because we have no idea when and where that's going to go. So gives us, we can obviously use some of that for operating if we need to until the state gets their act together. So. And
to Commissioner Litz's question earlier about your ARCs going up or down based on performance, the deposit of $10 million, in our opinion, would then necessitate a revised report from the Hay Group regarding the funded status and what your ARCs will be. The deposit should bring your ARCs down because you're going to substantially reduce the unfunded liability. So part of your annual ARC is funding the unfunded liability, which is mapped out over a number of years. And then alternatively, again, going back to your budget, we think that borrowing a pension obligation, some kind of note or bond, to fully fund it above what the $10 million gets you will then further reduce your general fund obligations, and when we subtract the debt from what your ARC would have been, we think there's a savings there over time. And you pointed out that your plan assumes that you're earning 7%. So the plan assumes that you're earning 7%. And so when you have an asset and you're compounding at 7%, that's obviously a very positive event because it's growing 7% on the balance year over year. When you have a deficit, you are essentially compounding that deficit. So fully funding it with debt at say 4% is a heck of a lot better than funding it at an implicit 7% rate over time.
County's existing debt is very low.
Very low, and very short-term in
short-term,
nature.
yeah.
You fund it, you don't lose the state reimbursement for your reimbursable pension plan. There's kind of a shadow report, we call it, that's submitted to a DPW so that you get full reimbursement. Otherwise, it would be you would be losing free money, if you will, and it wouldn't make sense.
Essentially.
So I go back to, if you're comfortable with your investment strategy, stay with the strategy.
I've been struggling with this and thinking about it a lot and listening to different points of view. This is my train of thought. Whether it was over the last however many years that this money was owed, it should have been paid, and therefore we would have been getting reimbursed. And that didn't happen. So it's now a complete financial burden on the taxpayers. So we've given $7 million, and if we give another 10, that's 17. As you said, there's 9 million left. I think we owe the money because it shows up on our audits, and we have a contract with our employees, and we do owe it to them for these pensions. And 80% is a good fund. So I could go along with the $10 million invested in our pension if the other $9 million is returned to the taxpayers. I feel that that would be fair, and roughly it would be a $200 check per household that they would get back, because the money from Cedar Haven is really their money. It's not ours. We have a responsibility to make sure the pension fund is secure, but we also have a responsibility to those taxpayers who entrusted us with their money, and if it's their money, they should get it back. Anything over that, what we really need, and I think that that last $9 million should be returned to the people.
So then in turn, then we should raise taxes to recoup that and to maintain our general fund then, right? Maintain our reserves.
We have eliminated the payment to Cedar Haven because it was sold. We are instructing our departments to add what is really due for the pension fund into their budgets, and then in turn that money is getting reimbursed, which it wasn't before. So it's going to be a little tough, but we should be okay. And so that is my condition.
You want to speak to that? Or?
I'd just like to make a motion.
Okay, go ahead and make the motion.
Move that we put $10 million into the pension fund, and that we keep the balance as a cash reserve to meet the Standard & Poor's request that we have 90 days cash on hand. And it's good fiscal management if you need an extra line in there.
Do I have a second? I'll second the motion. All those in favor of the motion to place $10 million in the retirement fund and hold the balance in reserve, indicate by saying aye.
Aye.
Aye. Opposed?
Aye.
Votes 2-1. Motion carries.